We just finished going through Ericsson's calendar 2026 second quarter earnings materials, and now we want to share our takeaways with everyone. Here's the question I keep turning over late at night, the same one every honest Ericsson holder is quietly asking. Can this company hold its fat margins long enough for the next wave of AI demand to actually show up? Because that's the whole ball game here. It's a race against the clock. On one side, margins that are holding up far better than anyone expected. On the other, a storm of rising costs gathering just over the horizon. So tonight, let's quietly figure out who wins that race. Let me set the whole board for you, because this deck frames the story as an hourglass and the sand is running. The company's organic revenue came in at -1%, basically dead flat, no growth to speak of. Normally I'd yawn at a flat quarter, but here's the twist that matters. The bottom line held up far better than anyone expected. And in a race against time, unexpected strength buys you exactly one thing, more time. The deck lays out the core question plainly. Can Ericsson's current margins hold up against a gathering storm of component inflation before the new AI in RAN demand finally arrives to save the day? On top of all that, there's a leadership change happening right in the middle of it. So this isn't a growth story tonight, it's a survival story. My read, the whole thing hinges on timing, and timing is the hardest thing in the world to call. Let me teach you the actual business first, because you can't judge the margins until you know where they come from. At its heart, Ericsson makes the base station hardware and software that runs the world's mobile networks, the boxes up on the towers, and the code inside them. The company splits the money into 4 pillars. 1. Networks, the base station radio gear. This is the big heavy anchor, the bulk of the revenue. 2. Cloud software and services, the telecom software ecosystem sitting on top of the hardware. 3. Enterprise, selling connectivity straight to corporations. And 4, and don't sleep on this one, patent licensing, renting out their 5G standard, essential patents, which is basically getting paid for owning the rulebook. Then there's the Horizon Catalyst, the DEX phrase. As AI moves into the physical world, all those edge devices will need massive low latency upload bandwidth. And the company's pitch is that this uplink demand lines up perfectly with what its 5G gear already does best. Hold on to that idea, because it's the light at the end of this whole tunnel. Now here's the picture in 2 dials, and they're pointing in opposite directions, which is the whole story. The first dial is revenue, and it's sitting right on neutral. Net sales of 52.7 billion Swedish krona, organic growth at -1%. Though to be fair to them, strip out a one-time patent payment from last year, and the underlying number is actually +1%, so it's genuinely flat, not falling. Most regions grew, it was really just a 1% dip in the Americas dragging it down against some tough year ago comparisons. But now look at the second dial, the one that's actually moving, gross margin. Adjusted gross margin came in at 48.4%, up a full 2 percentage points year over year. And the adjusted profit margin held steady at 13.1%. Here's the core message, and it's a genuinely impressive one. Management has engineered this company to defend a fat, profitable margin even when the top line isn't growing at all. Squeezing more profit out of flat sales, that takes real operational discipline, and I'll give them full credit for it. Alright, let's pop the hood and look at the 3 segments one at a time, because underneath that flat headline, they are in wildly different shape. First, networks the anchor, and this is a story of volume shrinking but pricing power holding. Revenue was 33 billion krona, down 8% year over year, but here's the part that matters. Adjusted gross margin held firm at 50.4%. They're selling less gear, but keeping the profit on every box. That's discipline. Second, cloud software and services, the star of the quarter, revenue of 14.7 billion, up 5% organically across every region, with the profit margin surging to 14.2%. That's the growth engine actually firing. And third, enterprise, which the deck bluntly calls the bleed, still draining capital. And even with +3% underlying growth, a business sale and currency swings knocked recognized revenue down 19%, with profit still negative at -0.8 billion krona. So one anchor holding, one star rising, one wound still open. My read, this is a company managing a portfolio, not riding a single wave. Now that software star deserves a closer look, because a 14.2% profit margin there is a record, and records always make me a little suspicious. So the natural question, is this a new normal or just one lucky quarter? I'll give management credit, they got out in front of it. Both the CEO and CFO explicitly said there are no one-off tricks in this number. Their explanation is that it's the delayed harvest of a multi-year restructuring, all that cost-cutting and pricing discipline finally paying off, multiplied by good operating leverage this quarter. And they're framing it as a milestone, double-digit profitability achieved, with a long-term goal of the mid-teens. But here's where I have to pump the brakes, and the deck flags it too. This software business is still functionally tied to how much radio gear customers are buying. It is not yet an independent cash machine. So one great quarter, as nice as it is, doesn't automatically become the new floor. Truthfully, I can't call this one yet. I'd want 2 or 3 more quarters before I believe the margin sticks. Okay, now we get to the thing that actually keeps me up at night on this one, and the deck calls it the hidden undertow. Here's the chain of events, and it's more than a little ironic. All that AI hardware hype, the same boom that's supposed to save Ericsson later, is right now soaking up the world's memory and DRAM supply. And that is quietly driving up the component costs for telecom gear today. Now the good news, in this quarter the hit was minimal because they had strong supply chain buffers cushioning the blow. But watch the timeline. The company says this margin threat starts compounding quarter after quarter beginning in the second half of 2026, running clear through 2027. And here's the trap that makes it dangerous. Ericsson's long-term contracts mostly don't have automatic price pass-through clauses. Read that again. When their costs go up, the price to the customer does not just automatically follow. So every single cent of that inflation has to be actively fought off by management, by hand, just to protect that 48% margin. That, right there, is the storm gathering on the horizon. So how does management plan to fight that storm off? The deck lays out 3 levers. Think of them as a tourniquet on the margin, and the whole problem is how long each one takes to work. Lever 1, cut costs and swap components plus push more high margin software. This one is fast, they can pull it now. Lever 2, renegotiate contracts, hike prices on new bids and reopen the old agreements. That is already underway, but it is a medium-term job. Lever 3, redesign the products to use less of that expensive memory. This is the real structural fix, but it carries a 6 to 9 month lag before it even shows up in the numbers. And there is the rub. Do you see the gap? The costs hit now, but the best fixes don't land for the better part of a year. The deck's own conclusion is refreshingly honest. The strategy is sound, but the time lags create an execution vacuum. In plain English, the inflation is going to visibly outrun the fixes through the back half of this year, and there is not much they can do to change that. Now here's a threat I did not expect to find in a telecom deck, and it's a very big name, NVIDIA. The deck says NVIDIA is aggressively pushing into the radio network space with its GPU-based chips right onto Ericsson's home turf. So how does Ericsson answer that? Their defense is what they call hardware agnostic, meaning their radio software is built to run on anything, standard chips, GPUs, or their own custom silicon. It simply doesn't care. And on today's battlefield, they have got a real edge for the actual radio work, which needs efficient, localized computing. The company says its purpose, built silicon beats a GPU on both cost and energy use, hands down. For now, I buy that a specialized chip usually crushes a general purpose one at its own job. But here's the subtle tell, and give the deck credit for admitting it. Choosing to be hardware agnostic in the first place is a quiet confession. It means even Ericsson doesn't know for certain which chip architecture wins the next decade. So they're hedging, and honestly, hedging is the smart move when the future is this murky. Now, this next one is fascinating, because Ericsson's biggest protection isn't something they built, it's something governments built for them. First, the threat, and to be fair, it is real. Investors pointed out that Chinese rivals get access to much cheaper local memory chips. That means those competitors could absorb the very inflation we just talked about, and then undercut Ericsson on price to grab market share worldwide. On pure cost, that's a fight Ericsson could lose. But here's the moat, and it's a wide one. Those Chinese telecom makers are largely barred from selling into the West on security grounds. So Ericsson's richest, highest margin markets, North America, Europe, Japan, are effectively walled off from its cheapest competitor. The deck's insight is sharp, and I completely agree with it. Ericsson's real defense here isn't being the cheapest, because it never will be. It's that its cheapest rival is structurally locked out of the room. That's a powerful moat, but I'd add one caution. A moat you didn't dig yourself is a moat that politics could someday fill right back in. Now there's a human layer here, because this quarter is essentially a farewell tour. After nearly a decade running the company, CEO Borjak Holm is handing the reins to Per Narvinger on the 1st of October. And I have to say, his candor about the past was striking. Almost brutal. He openly owned the ugly numbers, the stock lagging the tech index by 6-7% since 2017, 30 billion krona spent on restructuring, and around 60 billion in write-downs. His words, "We absolutely could have done things differently. Any denial would be dishonest." As an investor, you rarely hear a CEO be that honest about their own record, and I genuinely respect it. But here's the tension. That same candor vanished the moment anyone asked about the future. Pressed for the exact margin hit from component inflation next quarter, the CFO's answer was, "We don't disclose such details," and they wouldn't give a timeline for fixing enterprise either. So here's my honest read, brutally honest about the past he's leaving, a brick wall about the future he's handing over. That contrast alone tells you exactly where the soft spots are buried. Let me play referee now and translate 3 things management said into what they actually mean. Quote 1 on margins, robust margin resilience has been successfully established. My translation, true, but read it carefully, that's a defensive win, not an offensive one. They protected the profit, but the top line is still flat as a board. Quote 2 on the catalyst, AI moving into the physical world is our next structural growth wave. My translation, the thesis is technically sound. I do believe the demand is coming, but the timing is a total question mark. And tellingly, their own internal planning still assumes a flat market. Read that, they believe the story, but they're not yet betting the factory on it, which is actually prudent. Quote 3 on the threat, component inflation will be mitigated through pricing and redesign. My translation, the tools exist, sure, but there's huge execution risk from those time lags, and they flatly won't put a number on the gap. So across the board, the words are confident, but the actions are cautious, and the key numbers are conveniently missing. Here's a great tell what the institutional analysts actually chose to grill them on, ranked by anxiety. Number 1, by a mile, component inflation and pricing, around 5 direct questions on that alone. This is the core fear. Analysts demanded the specific dollar impact of those memory costs, and management admitted the hit is coming in late 2026 and 2027, but strictly refused to put a number on it. When the most asked question gets the least answered response, pay attention. That's where the fear lives. Number 2, moderate anxiety, margin dilution from the mix of projects, about 3 questions, and management gave only a vague shape, recovering after a few tough quarters, but no concrete baseline for the year. Number 3, and interestingly the calmest, the AI in RAN and silicon strategy, 4 questions, and here management was confident and precise. So notice the pattern. They're relaxed about the far-off future and evasive about the near-term costs. Usually it's the other way around, and that inversion, honestly, tells me the next few quarters are exactly where the real risk sits. Alright, the deck puts its own worries onto a radar screen with 4 warning lights, and this is the honest risk list, so let's walk it. The red light, the brightest one, is that unquantified inflation, costs eroding margins from late 2026 into 2027, with the total damage deliberately kept hidden. Then 2 orange lights. The first orange, and this one is concrete, they've already guided next quarter's network's margin down to 48 to 50%, a real step down from the 50.4% they just delivered because of a worse mix of projects. That's not a future worry, that's happening right now. The second orange, stagnant revenue, organic growth at -1%, and management itself admits the core market is flat, with the industry trackers seeing barely 1% growth. And the yellow light, enterprise still bleeding with no turnaround date. Plus, and this one's subtle, inventory jumped by 5 billion krona in a single quarter. Now some of that stockpiling is actually smart, buying components before they get pricier, but rising inventory on flat sales is always something I watch closely. 4 lights and not one of them green, that's the honest picture. So let's bring it home. The deck's final verdict is a phrase I want you to remember. This whole investment is a race against the clock. Ericsson has to outrun the erosion from component inflation, using those defensive levers just long enough for the real prize. Physical AI and that uplink demand to finally show up. Get there in time, they win. Get caught short, the margin cracks first. And they hand you 6 gauges to track exactly who's winning that race. 1, network's gross margin. Can it hold that critical 48 to 50% floor? 2, price renegotiation. How fast can they actually push those costs through to customers? 3, component transparency. The big one. When will management finally put a real number on the memory hit? 4, enterprise profit. Is that bleed actually trending toward break-even? 5, the patent royalties. Does that run rate hold above 13.5 billion krona a quarter? And 6, uplink conversion. Does the theoretical AI demand turn into actual signed hardware orders? Print this list, tape it to your monitor, and you'll know who's winning the race before the crowd does. Alright, last thing, radar always leaves you a light. I'm weighing it all, the genuine margin resilience, the rising software star, the geopolitical moat that keeps the cheap competition locked out, against a flat top line, a margin storm that management won't put a number on, an execution vacuum coming in the second half, and a CEO walking out the door. And I'm calling this one yellow. This is a good, tough, run business. That part I don't doubt. The discipline on display is real. But there's one big variable I cannot get them to quantify. The size of that inflation hit, and it lands right when the fixes are still lagging, so I'm watching, not buying. Here's what flips me to green, and I'm telling you this up front. Show me the network's margin hold that 48% floor through the storm. Or show me AI in RAN turning into real hardware orders, and I'll happily turn this light green. And what turns me red if next quarter's margin breaks below 48% and that inflation visibly outruns the levers? I step aside until the dust settles. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.